Hi, everyone. This is Rob Roy of Elliott Wave Options, and welcome to this presentation on my favorite technical indicators. You can see from the title, it's called AI-powered Elliott Wave. So in general terms, Elliott Wave is my favorite indicator, but there's a lot of complexity to the world of Elliott Wave, and I think I'm going to show you something that's a little bit different. If you have some familiarity with Elliott Wave, I'm going to show you something very specific. So my favorite indicator is one very specific part of Elliott Wave, not the whole general program of Elliott Wave that you're used to. If you're not familiar with Elliott Wave, let me just give you a real quick background of how Elliott Wave came to be. There was a gentleman named Ralph Nelson Elliott, lived back in the late 1800s, early 1900s. He worked for the railroad. He was known as a mathematician. He became physically debilitated from a disease he caught working out on the railroads. So he became homebound and got interested in the markets. And based on his mathematical brain in learning the markets, he felt like he could take what had happened in the past, watching the markets, the actions of people, the patterns that occurred, and create a mathematical algorithm to give a reasonable degree of accuracy on where things were likely to go. So it takes into account supply and demand, fear and greed, all the main things that drive the markets. And he also believed that the markets move in a series of impulses and corrections. Those are terms that are usually used widely with Elliott Wave. So this has been around for 130 years, so it's not some fly-by-night thing. People have varying views on Elliott Wave, and I think that when someone tells me they haven't had success using it, then I talk about the fact that they likely haven't spent enough time learning it because it is very complex. But my goal is to try to simplify it down and just give one little specific way that we can trade Elliott Wave. So with that, we're going to talk about the difference between analysis and trading. I like to look at Elliott Wave from a trader's approach. A lot of people get so caught up that are what I call Elliotticians, that are so intent on getting all the labeling right within the patterns, it becomes paralysis through analysis, that common phrase, where they get so focused on getting all the counts right that they lose the bigger picture of how can I use this to enhance my trading. So we'll talk about that, and we're going to talk about trading opportunities within the wave three. Most people familiar with wave 1, 2, 3, 4, and 5. You go out on the internet, you look up Elliott Wave, you see that common pattern that shows 1, 2, 3, 4, 5, and then an ABC correction following the 5. That's the general view of Elliott Wave. The also general view is that within the Elliott Wave pattern, wave 3 is the strongest of all waves. That's when institutional buying is occurring. But most instructors or most programs that educate traders on Elliott Wave talk about stay away from the wave 3, trade the wave 5, let 1, 2, 3, and 4 occur. And if they've all followed the rules and have lined up within a typical Elliott Wave pattern, well, then you have a higher degree of accuracy in trading the wave 5. But my viewpoint was, why do we want to ignore what everyone agrees is the strongest of all waves? Well, one of the problems within the wave 3 is where is it going to end? So if we have 1, 2, 3, and 4, we kind of have an idea where 5 is going to go, but that tends to be more on the retail side. The FOMO, that's the end of the move. That's when those that feel like they've missed this big trending move want to get in, and sometimes that move fails, and it fails way more often than the wave 3 does if the wave 3 is strong. So let's trade the wave 3. All right, well, how do we know when the wave 3 is going to end? That's the challenging part, and that's what this presentation is going to be, how we can access trading the strongest of all of the Elliott Wave patterns, and then how we can have a reasonable degree of certainty where that wave 3 is going to end, knowing that nothing's 100%, nothing's 100% accurate, and there never is. There's nothing in the world of trading, but all we're trying to do is put as many percentages in our favor as we can. We'll give you an idea of our performance, and we'll give you a trading plan on trading this wave 3. So I'm going to give you an idea of how to go from start to finish within trading the wave 3. So trading versus forecasting, as I mentioned a few minutes ago, a lot of people just get so technically focused on creating all these waves. I get commentary from people all the time. I do a YouTube show on the weekends And people are always getting really detailed on the intricacies of labeling the patterns, and it's just telling you you're missing a bigger picture. We're just trying to figure out how we can get a little chunk out of that wave 3, knowing that nobody hits the exact bottom, nobody hits the exact top. It's not even realistic to think that you can do that. What we want to do is take a consistent chunk out of that strongest of all waves and generate a nice gain and move on to the next position. But what an analyst will do is try to manually count the Elliott wave counts at times, and I've yet to meet the person that could do it by hand. It does require software. Elliott wave programs are, as I mentioned, very complex. If you've ever looked at the actual algorithm, it's about 30 pages front and back. I always use that movie, A Beautiful Mind. If you remember Russell Crowe writing all over multiple boards, that's kind of what the formula looks like, the algorithm looks like to me. I don't pretend to understand all the intricacies of that, and I don't want to, and I don't think you have to utilize Elliott wave in becoming a trader. But people that more engineering type minds get so focused on that. What a trader does is allow the algorithm to do its thing, and that's where the software comes in. An analyst might limit or analyze limited markets using a software program that lets the algorithm run. You can look at anything that's securities based. I tend to focus on the world of trading options, hence our name Elliott Wave Options. So I'm looking for any security that is optionable. That's where I limit my search, but you can use it for any stocks. It's all the same thing that applies if you're a futures trader, if you're a currency trader, if you're a commodities trader, any of those different markets. All the same stuff works. And by the way, it works in the same time frame. I usually work on trading intraday, end of day charts for my actual own trading and what I send out to the subscribers. But during the day, like just before we started here, I'm watching a 3-minute chart of the market. So the same patterns show up regardless of the time frame, which is also a nice aspect. So the analyst is taking a really deep analysis. We're just looking at it from a higher picture, just where's the entry, where's the exit kind of thing. They tend to have a longer term focus over that whole 5-wave pattern. My focus is way more short term. I'm looking on how do we just get in, take a little bit of piece of that wave 3 and move on. And it doesn't matter whether it's an upward trending Elliott wave pattern or a downward trending Elliott wave pattern. Again, if you're not familiar with Elliott wave, it works in either direction, up or down. This is a directional based pattern that I'm going to be showing today. There's ways to trade sideways, but we're not going to cover that in this presentation. So an analyst will use it to forecast, predict market turning points, etc. And once again, I'm not going to look at it from that standpoint. I'm just trying to find trading opportunities that I can use in a relatively short period of time. And the average trades you'll see, I'm going to show you the data, is just over 3 weeks, is the average amount of time to hit its target. So what I'm looking at is something called a zigzag pattern within the wave 3. That's how we determine where that target price may go within the wave 3. Zigzag patterns, if you do have familiarity with Elliott wave, this trips some people up because they're like, wait a minute, that's one of the corrective patterns. So when you see that general 1, 2, 3, 4, 5 on the internet followed by an ABC, the ABCs are the corrective patterns, and they're flats, zigzags, and triangles. I trade all of them, but again, we're focusing on the directional based zigzag in this presentation, and it's a 3-segment move. That was the terminology that Elliott used. It came over time to be known as waves, as the curvature of the impulses and corrections almost tends to look like a wave. I live in Florida, so pretty familiar with waves, but Elliott himself used the term segments as far as the movements. So I'm trying to explain the terminology as I go. Now, Elliott himself was a big fan of Fibonacci levels, and I am as well. And we can argue over whether or not Fibonacci levels work, for why they work, I guess would be the argument. And I don't think it really matters, is what I usually talk about. Whether or not you agree that there's some mathematical order to the universe, or you just believe that there's so much program trading now And people have come to rely on Fibonacci levels as areas of support and resistance. And if they're just setting up their programs, their stops, their exits, et cetera, around Fibonacci levels, then it becomes a self-fulfilling prophecy, right? If enough people are looking at these levels, then they tend to work. So regardless of the reason, they do tend to act as pretty amazing points of support and resistance. So I utilize those. And as I said, Elliott mentioned them as well. So when we're looking at a zigzag, it is one of those corrective patterns. It's three segments, as I said. It's A, B, and C. So what we're looking for here is when you see this movement up in the A and then movement down in the B, then the C wave extension is what we're going to look to trade. And then we have these fib levels that give us an idea. Is it going to extend to the 61.8% level? Is it going to extend to 100? Is it going to extend to 161.8? And there's guidelines to tell you exactly the idea or which one of those you're going to focus on. It can be any of them, but there's rules as far as which one it may come out to be. Another point about Elliott wave that you may or may not know is every one of those 5-wave patterns starts with a zigzag. So before you see a program label or a pattern label into a 1, 2, 3, 4, and 5, it started with an ABC that then moves itself to a 1, 2, 3. So this ABC would relabel. So even though the entire 5-wave pattern starts that way, we're looking for that just within the C wave. So I'll show you that as well. So referring to those Fibonacci levels as the idea of when we want to exit, I'll give you the details on when we get in. So I'm going to give you pretty specific entries and exits so that you can apply those in your trading if you like. And when you're looking for definitions, again, on a Fibonacci extension within a trending impulse move, it's all the same thing. Basically, it just depends on the terminology of what you're looking for. But we have target areas for, we have specific entries, and then we have target areas for our exits. So let's talk about how we do it. Trading zigzags within the wave 3. As I mentioned that all of the 5-wave patterns start with a zigzag. So this would have started as an ABC. It's now relabeled into a 1, 2, 3. So the algorithm is showing you now you're in a traditional 5-wave pattern. But we're in that wave 3. And what we're going to look to do now is trade that zigzag pattern that occurs within the wave 3. It's so strong. And again, remembering that the market doesn't go in a straight line forever. It moves in impulses and corrections. I think we can all agree on that, regardless of what your viewpoint may be on Elliott wave. There is no doubt that the market moves in upward moves and then corrective moves, upward moves and corrective moves. So the terminology gets a little bit confusing when you talk about a corrective move. A lot of people just have in their mind a corrective move is a downward move. Well, that is if you have an upward trending pattern. But if you have a downward trending pattern, then the impulse is actually down and the corrective move is up. So the corrective move based on Elliott wave terminology is a move against the previous impulse move. So you identify what direction the impulse is going, and then the correction is going to be in the opposite direction there. So here you can see that we have that 3-wave pattern within the wave 3. So an ABC here located within the wave 3. That's the ideal scenario that I'm looking for. This is what I want to do, is use this pattern to come take a chunk out of that wave 3 and leave it at that. So we give both entry and exit targets, as I mentioned. So how zigzags can help trade the wave 3. So they give you an entry point. So here's the pattern. There's the wave 3. We're looking for that strong wave 3. We're wanting to trade this zigzag pattern within it. And then we look for those extensions as far as where the target's going to be. Well, how do you know which of those targets? Depending on how far this B wave correction goes, gives you the target price of how far that extension on the C wave, which one of those fib levels we're going to go to. So we're going to look in this wave 3, and we're going to let the A and the B form within this wave 3. And then we're just going to trade that last segment, the C wave. And so when we have this little corrective move within the wave 3 here, that orange line that moves down, depending on how far that corrects, gives you the fib extension on where you think it's going to go. And I'll show you how to go through and identify those. Pretty much every software program on the planet now has fib retracement and fib extension tools, so it's easy to go through and measure them, whether or not you're using an Elliott Wave software program or not. So this is one of the things that I discovered. I just had this thought of it makes no sense to be avoiding the strongest of all waves and waiting to the wave 5. It takes longer. They're longer patterns to set up. You're waiting around for quite a while, and just avoiding the strongest wave made no sense to me. And so that's when I embarked on how can I find a system that works within the wave 3, and that's where the zigzags came from, noting that you can have a corrective pattern within an impulse. It doesn't have to be the completion of the 5-wave pattern before you get one of those flat zigzag or triangle type corrections. You can have corrective moves within the bigger impulse, especially the wave 3. So I was trading that. I was doing pretty well with it. And then something interesting happened. I started talking to an organization called HUBB.com. They're software developers. And I said, hey, I hear that you guys are moving into the world of AI. And that you're starting to incorporate AI into your technical analysis. Well, I've got a little system here. I'd like to see you take a look at it and see if you can improve it. Make it better. We're always looking to improve, right? It doesn't matter how well we're doing. We're always wanting to get better. And they did. And I'm going to give you just a real brief summary of exactly what they did in order to what I call supercharge a system that was already showing success. And I've been trading Elliott Wave, by the way, since 2001. I should give you a little bit of my background. When I was first taught about Elliott Wave, my first career was as a golf professional. When I left the world of golf, I moved into finance. I became a financial advisor. I became a registered securities principal. I left that because I just didn't like the way the whole investment advisory world worked. I felt like they were a little more interested in the company's bottom line than the success of their account holders or subscribers. And I'd had some success trading options. And the final straw was when the broker-dealer came to me and said, hey, you can't trade options. And I said, well, okay, well, I'm not recommending options to any of the clients. And they said, no, you can't trade options either. And that was when I said goodbye, because I'd had success doing it. And so I just started trading on my own. I ran into a gentleman that was really good at technical analysis. He started talking to me about Elliott Wave, and it went in one ear and out the other. Sounded like a bunch of hocus pocus to me at that point in time. But then he said, all right, well, let's look at this chart. And he showed me a chart of the NASDAQ. This was in 2001. And he showed me the NASDAQ going down to a target that I thought was unrealistic. Well, then we know what happened in 2001. September 11th occurs. The market's closed for 4 days. The market reopens. And lo and behold, after it opened, it went down. Obviously, we knew the markets were going to go down after they reopened, but it went down and hit that exact target that he had shown me. And I knew that he showed me that well ahead of time. And that was the point for me when I said, well, maybe I should take a look at this. And I haven't turned back since then. So I've been trading Elliott Wave since 2001. Well, in supercharging this by adding AI into it, I launched a customer service using this specific system back in 2021. And the Elliott Wave calculations and the AI ratings work as separate functions. So what they're doing with the AI is not AI-ifying Elliott Wave. They're looking at different data points within an Elliott Wave pattern to try to give a score of the likelihood that that wave 3 is going to continue. And they have a target too, which doesn't coincide with the Fibonacci levels. They're target based on the data points that they analyze. And what I really like is that when you have a setup and the AI target that it gives me coincides with where the zigzag C wave extension is. When those two agree, those tend to have an unbelievably high success ratio. So that's my favorite. They don't always line up exactly, but when they do, it works out great. So using AI for these trade setups, the data scientists took what I was looking at, which was a very basic technical system, and they added a whole bunch of their AI stuff. They AI-ified it and going through and accessing it. Now, some of the general things that they take a look at are things that you can see here that you could find on your own out there on the internet. Price to volume. And by the way, I want to take a moment to mention this. A lot of times people ask me, what do you think is the most important part of trading? And I'm a believer that you have to have a technical trading system. I'm showing you my favorite system right here today. But regardless of what your favorite system is, what your technical analysis system is, I'm just a believer, it's my belief for whatever that's worth, that price to volume always matters, and it should be a part of anybody's technical trading system. If a stock goes up on strong volume, to me that has more meaning than if a stock is going up on declining volume. It seems like that means that that move is running out of gas. But if it's going up on strong volume, then perhaps it can continue. But anyway, digress a little bit, but indicator values, benchmark comparisons, indicator value rankings, statistical measures, intermarket correlations, economy cycle data, and company options data. Now, as I said, you can find all those things on your own out there on the internet, but they take it a lot further than that. They look at over 300 different data points. Those are just some general ones. So if you have the computing power, if you have the time, if you have the knowledge to go dissect those, then you can create somewhat of a system. But unless you're a data scientist with the big supercomputers, with the power to create these AI algorithms, then you can't really compete. And I'm kind of the belief that that's where things are going. I think everything is going to be moving that way in the world of technical analysis into the future. I feel like we've gotten a head start on a lot of people. We're out in the forefront where not only have we already created a system that's been AI-ified, but we've been posting and sending out actual alerts for quite some time now with an actual posted track record. So I think we're ahead. Now, these are their general things. Then they take it to a little bit further where they talk about regression, clustering, random forest, ensemble-based networks, and neural networks. And I look at those. I have no idea what the majority of that stuff means. I do know what a neural network is. That's basically when you give AI a problem or a situation and you ask the AI to solve it. That's a very basic definition of what a neural network is. But they're using all these different models and all the data points and stuff that I just don't have the mental capability to look at. So here's an example of kind of what each one of their data points looks like. It forms a cluster. Some people have joked and said, oh, it looks like an ultrasound. Well, the main thing is that these are clustering results, and the key point there is, where do the clusters agree? So they sent a bunch of them, so I'm not going to sit here and go through all of them with you. I'll stop. And then they sent me this slide, and then it showed all of these different pictures. And this is the 36 of what the data scientists consider to be of the most important of the 300 plus data points that they look at. So in general terms, just looking at this, basically what the AI program is doing is taking each one of these data inputs, and the result is what you see on your screen. The clustering is what we're interested in, and then it runs a comparison to see, where do these clusters agree? How often do these clusters agree within the 300 plus data points? And it gives a score, gives you a score of what the likelihood is of it going up and hitting a particular target. So it gives you a price target. And by the way, for those of you that are interested in stops, it gives you a fail zone. It also tells you when this could be a failure, because there's never a rating of 100%. Again, that doesn't happen. There's no such thing. Nobody should expect that. But it gives you a score on the percentage likelihood it's going to hit the target. It gives you a fail zone. I'll show you that in a moment. But this is what they sent me. I'm a visual learner. I couldn't understand all the wording that they were talking about. And I said, I learn visually. Can you send me pictures so that I can kind of look at it? And this is what I was sent. So in general terms, basically, they're just taking each one of these individual data points, going through the analysis, and then figuring out, where do they all agree. So that, in general terms, is how it works. Now then, on the software program, and by the way, hang in there till the end, I'm going to show you how you can get a copy of this software for free. And so we look at this right here, and these are the signals that I get. I get them right now. And so it shows an AI confidence rating. Now, 84 is a high one. So we're giving you one that's a high rating. We look at anything that has a score of 75 or above is something that I'm interested in. Again, I've seen a rare 90, but those are rare, but nothing really much higher than that. So there's always a degree of potential risk. There always is in the world of trading. But here's the fail zone. I'm not a big believer in putting in physical stops. Market makers can see them. Anyone that has put in physical stops has probably experienced this phenomenon where you had your stop in and the stock came down, it hit your stop, you got stopped out, and then just like clockwork, as soon as you got stopped out, the stock turned around and went back the direction you thought it was going to go. And that just seems to happen too often. So I'm not a believer in actually putting in physical stops. I like what are called mental stops. And that's what this gives you, is it tells you, okay, here's where this position is going to fail. So if it were to come down and hit this level, that's your stop and you're out. Otherwise, you hang in there as long as it stays above the fail zone and wait for it to reach that target. And even if it hasn't reached my fib target, I tend to give a little nod to the AI score, and I will exit then. As you know, if you have a strong impulsive move, you're likely to see an IV injection. Applied volatility is probably being injected into the call options in this case because it's movement to the upside. And you can use this with just basic calls and puts, by the way. You can get into debit spreads, credit spreads, butterflies, any of the more advanced strategies, condors, etc. I do like doing out of the money butterflies when the options and the liquidity allows. But you can do it with just straight calls and puts depending on your level of expertise in the world of options. So when it hits this target, if it hasn't reached the fib level, which I think does have still merit on where it could go, we're probably getting out in the stronger part of the move. There may be a little bit of that extra IV injection in there, and that helps you when you go to sell the call to perhaps get a slightly higher price. Maybe you've seen a move similar to this before and it backed up a little bit and then it turned and went higher. And even though the stock was trading higher, the call option wasn't worth as much as it was when it had this big, more vertical gap up type of a move. Not necessarily a big fan of gaps because they get filled a lot, but sometimes these things take off and run vertically. Other times they take their time. So clearly AI is more sophisticated than the average trader can really realistically achieve. So unless you have that computer know-how, as I was talking about, you basically need software. And again, I've yet to see the person that could just label basic Elliott wave by hand manually. People try though. I hear from them all the time. It doesn't look like that to me. Well, there's a lot of times when I look at a chart and it looks like, oh, that looked like a corrective move. I wonder why I didn't label it, but the algorithm doesn't label it. So here's a preview. Hub.com is where you can go. I'm going to show you that again at the end, but that's where you can get a free copy of this software. It's brand new. They've reprogrammed it. It's going to have these AI signals here pretty soon. Gives you a chance to go get it now free while it's in beta form. Start to play around with it, get used to it. It's an amazing piece of software. And if you do have any interest or knowledge of Elliott Wave, I think it's the best Elliott Wave software. I've tried them all. I've been a big Elliott Wave fan for a long time, as you know, and I'm going to use whatever software program I feel like is the best and most accurate. There's a lot of programs out there that are personal adaptations of Elliott Wave, but the Hub organization programs it exactly to the algorithm as Ralph Nelson Elliott wrote it. And I'm kind of a believer that if you're going to follow somebody's system, then you ought to follow their system. And if you're dealing with a program that's had some personal adaptations in it, unless you really fully understand the adaptations that that person has applied in there, you may not have as much success with it as someone else. So if you're wondering, well, how does this work? Then I'm going to show you some more details here, some more specifics on entries and exits in this, but the proof is always in the pudding. You want to see what the track record has been. And this would be the performance that we've seen since we went live with this. And these are actual results that are sent to subscribers. The reason it says hypothetical underneath there is we start with a $5,000 model account. We do not compound. None of these results are compounded. Everyone's in control of their own account. They can do whatever they want, depending on the size of their account, whether or not they want to compound their trades and make the future ones larger. But we're adding people all the time, so we want to give everybody a fair shot. So it's always based on that. But this is generated since the AI came in. I just want to be clear on that. It wasn't 83% before, but since the start of using the AI, it's had an 83% winning track record, 27% average ROI, which doesn't sound super fantastic. But again, we're just trying to take a chunk out of the middle of that wave 3. The account ROI, though, is pretty good, because even if you're only making 27%, if you're doing that a lot, it starts to add up. And then the average number of days is 24 days. And you're going to see in a minute a chart that shows the difference that putting the AI has made into the system that I had before. And that's this chart here. It basically cut in half the amount of time that I was in trades. So when we launched this service in general back in 2018, you can see that we had kind of leveled off right around 50 days. So we would be in a trade around 50 days on average. There's when COVID hit, we had some movements there. We had some, outlandish moves, big moves, short period of trades. So there was a little tick down there. And then over time, as the market started moving up a bit slower, then we started to have a little bit more time in the trades, and then it leveled off around there. Well, once the AI came in and started using that exclusively with these patterns, you can see what has happened here with the amount of time in the trade. So the average time is now more than cut in half. So from just under 50 days average in a trade to now 24 days. So it hits its targets much quicker now, with the advantage of putting AI into this zigzag pattern within a wave 3. And then if you're wondering, well, what about the activity? Everybody wants to know, how active of a trader are you? Well, that shows the average number of trades per month that I was doing prior to that. Once the AI came in, look at the difference in the amount of trading activity. So not only is it cutting the amount of trades time in half, so cutting the length that you're in the trade in half, it's nearly tripled the amount of activity. So you can see what that matters to the bottom line as far as where your results are towards the end. I did set a new personal best. At one time, I had 19 closed winning positions in a row. So that's my current record from the amount of time I've been trading. I've been trading in general terms nearly 27 years, trading Elliott Wave since 2001. And then here's a listing of those just to show you that they are posted. So these are actual, these aren't made up. These aren't paper trades that were back tested. These aren't back tested results. These are actual alerts and actual trades that were sent out to our subscriber base. And then we do post prices that we know were filled, not just what's the price, what's the mid price when you send it out. All right, so let's go back and look at the system again, now that you've seen how well it works. So let's give you some rules and guidelines. As a rule, when you're looking at one of these zigzag patterns, the B wave must retrace at least 20% of the A wave. So that's a rule. Elliott always talked about these things called rules and guidelines. So rules versus guidelines. Hard, fast rule cannot be violated. A guideline is just something that, hey, this happens a lot, kind of keep an eye on this. So that's the difference between the two. If a rule is violated, the pattern either becomes disqualified or you exit the position and move on and look for something else. Now, the rule, and this is what Elliott would admit, being a fan of Fibonacci ratios, he admitted, okay, 23.6 is a fib level. And if the B corrected down to 23.6, then he counted that, and that would be labeled because it was a fib level. However, if you read his works, and he's got, some old published books out there, I've read everything. I've read some of his personal notes, etc. I got really absorbed into it when I became a believer in the system. And he would talk about how he just didn't have as much faith in the 23.6% fib level. He would prefer to see that B wave come down a little bit further. So he wants to see it come down to at least 30% and would prefer it to come down to that next fib level around 38.2. Now, I've mentioned that it's amazing how often Fibonacci levels act as support and resistance, but they don't always exactly hit those labels. So if it gets beyond 30%, he feels better about it. It's moved past the 23.6. In his view, a 23.6% correction could have the potential to relabel and just be one big impulse. So that wasn't sure that that was a full-on B wave correction, that maybe if it just comes down here 23 or less than beyond between 20 and 23, then you turn, go back up, and all of a sudden that A moves over. And it really wasn't a B wave correction. It was just an extension of the A, and you're still waiting on the B wave correction. So obviously you wouldn't want to get in on the impulsive A move when you have a B wave correction getting ready to come into the mix. So that's more of a guideline, but he kind of liked that a little bit better. And so I follow along with that. I much prefer it when the B wave corrects somewhere in the area of that 38.2% level. Now, if it moves down to 70%, then now we look at that's likely a failed zigzag pattern and can move into a flat. Now, a flat is a three-wave pattern. And again, we don't have time to go through all these corrective patterns. We're just focusing on the zigzag in this presentation. But a flat is a sideways pattern. So basically, it would be highly likely that that B wave would come down further, somewhere in the area of that 0 point where that A wave started. And then you would move up and go back up to about where that A wave was. And it's a three-wave sideways pattern. So it's a channeling pattern between support and resistance. So if you break down towards that 70 level, now 78.6 is the last fib level. That's the last bastion of support. But again, his guideline or his thoughts were, if you hit 70%, you're probably coming down to 78. So it's probably a failure anyway. So he would look that if it corrected down to 70%, let's just go ahead and exit that position. More rules. The C wave must be longer than 90% of the wave B by price. So that's a rule with an Elliott wave. So you're looking at that C wave, it has to move more than 90% of B now, not A. It has to move more than 90% of B. If it does, then this becomes qualified as a C wave. Now, there's different terminology here. There's patterns that are qualified, and then there's patterns that are confirmed. Just because it's qualified doesn't necessarily mean it's going to play out. What you want to wait for is when the pattern actually hits confirmation, when it becomes confirmed a C wave. And again, there's still no 100% guarantee it's going to happen, but you want a confirmed pattern. You don't want to jump the gun and enter just when it becomes qualified. I do that at times because I feel like over all these years, I've gotten a pretty good feel for which ones are going to work and which ones aren't. But if you're just following the system, then you want to wait for that actual confirmation. Now then, how far is the C wave going to go? Well, we know the fib levels are going to come into play, but in very general terms, you would expect that move from B to C to be approximately the same move price-wise from 0 to A. And they do stay rather uniform in their patterns. So you can see here that it's pretty uniform. The A and C are basically parallel lines. And it is amazing how these patterns do stay in uniformity, if you will. They don't get just kind of out of whack from a visual standpoint. The second most likely length for the wave C is to go 61.8% of A. Sometimes we run into that fib level and hit that, and that can be the end of it. To me, 61.8 is my favorite of all fib levels. I think it's the strongest of all the fib levels, so I pay attention to that when it hits it. And just a side note, if you're a currency trader, you're probably familiar with a 78.6% fib level in the world of currencies. 78.6% shows the strength in support and resistance that 61.8% does in equities. And then the third most likely move is an extended C wave, which moves up to 161.8. Oftentimes, because we're in the wave 3, and this happens more often when you're trading these zigzags within the wave 3 than, say, a wave 5, because the wave 3 is so much stronger, you can get an extended C wave, which moves to that next fib level of 161.8. And that's when some of my confirming indicators come in. We all have our own favorite indicators. I really like the DMI. The ADX and the DMI gives you an indication of the strength of a move. And then there's two directional indicators that tell you whether or not currently buyers or sellers are the ones that are in control. So if it hits 100% and that DMI shows that it's still very strong, then I'm likely going to stay in that position and wait for the expected move up to the 161.8% extension. However, if I hit the 100% extension and that DMI is not showing that, hey, there's strength in this move, then that's the exit at the 100% level. So I look at the CCI and Chaikin money flow as well as a conglomeration of confirming indicators when I'm looking to see if we're going to get that C wave extension. So that just gives you a little bit of my supporting cast, if you will, around these zigzags within the Elliott wave 3. So just to give you a refresher here, these are the targets we're looking for. If the B wave retraces just to the 38.2% level, the C wave, you're not looking for a 100% extension. The extension you're looking for is 61.8. So it does matter how far that B goes. So if the B corrects down to 38.2, your C wave extension target is 61.8. If the B wave corrects down to 50%, then you are looking for the C wave to extend 100%. And again, that's of the A wave. So we're talking about 61.8% of the C wave as to the A wave. And then here, 100% means basically that move from B to C is the exact same move as from 0 to A. And then if the B wave corrects down to that strongest of all fib levels, the 61.8, then we are still looking for the 100% extension target. And then we look at the confirming indicators to see, is that it? Are we done? Is that the end of the move? Or could we be looking at an extension in that C wave up to the next fib level? Now, one of the questions that comes up when you see this is, well, if you just focus on the 61.8% level, you're going to miss the trades where the B goes down to 38.2 and bounces. You're going to miss the trades where the B corrects to 50% and then bounces and goes to the C wave. And you're only going to be trading the zigzags where the B corrects to 61.8. That's true if you're just focusing on waiting for the setups where the B wave corrects 61.8. So what I would suggest as a consideration, if you will, if you see a pattern where we come down and we hit that 38.2% level and it bounces, oftentimes they will do that because it acts at least as temporary support. Even if this B wave is going to correct down to 50% or correct down to 61.8, you oftentimes will get a bounce off 38.2 because it is a fib level and could act as short-term support. So if you don't want to miss out on any of them, then perhaps and everybody should have an amount that they're willing to put at risk in any one position, right? It's just good portfolio risk management. Well, perhaps if you see it come down to the B wave and bounce, put a third of the amount that you would normally put at risk in a position. And then if it continues down and hits 50%, add the second third. So you're kind of dollar cost averaging a little bit here. And then if it does move down all the way to the 61.8 and bounces, then you add the final third. And that way, at least you're participating in all three of these patterns. That's just a consideration if you really want to be super active and trade them all. Otherwise, then you can just wait on those Bs that go down to 61.8 and put your amount at risk in there, regardless of the amount that the B wave had corrected. So an end-to-end strategy, just a simple zigzag trading, strategy is we look for the basic setup, we identify the signal day, qualify it, then we look at risk versus reward. We enter when it's confirmed. Remember, there's a difference between qualification and confirmation. And then managing and exiting the trade, we utilize the Fibonacci levels, volume, the other indicators that I look at. I mentioned that the DMI is my favorite, so that carries a lot of weight to me on when to exit the position, whether you exit it at that first fib extension or you wait to see if this one could run a little bit more. So that's in general terms. So what you're looking at when you see the pattern is we start off, we have the A, we get the B wave correction. We've followed the rule, greater than 20%. We've got the C wave extended more than 90% of B. So we're ready there. And this is what I mentioned to you earlier that, yeah, I've snuck in a little bit earlier before the actual confirmation day. But if this is something that you have no familiarity with it, but you want to give it a try, I would encourage you specifically in the beginning, stay with the rules, follow the hard, fast rules. And at some point, you'll start to see what I mean is that you kind of get a feel for which ones are going to work well. And then your target areas are the fib extensions. So that gives you your plan on when you look to get out. Which of the levels is it? Is it 61.8? Is it 100 based on where that B wave correction is? And once we hit one of those two levels, are we going to go to the next level? Now, one other comment is if the B wave corrects 38.2 and that target is 61.8, the extension level there, if the DMI was still showing strength and a likelihood of the move to continue, your extended level would be 100%, not the 161.8. 161.8 is the extension level if the original target is 100%. 100% is the extension level if the original target was the 61.8% extension. So once we qualify on that 90% rule, then we know that that's a qualified pattern. And then the entry threshold is when you close above that level, that's when you move to qualification. And that's what we want to look at as far as getting in. So looking at this again, the difference between qualification and confirmation, the move here is your risk is the entry point minus B. So if this fails and comes down and violates this B, you can either just exit that position depending on where B went. Or if it was at 38.2 and you only did a third of the position, well, then you're just waiting to add to it when it comes down to the next fib level. So initially, that's your risk. From there, and then your potential reward is moving up to one of those appropriate fib levels, whichever one it happens to be. So we look at this, we identify the risk versus reward. Does it make sense? In the zigzag, you may have a higher pivot point above the B wave, which allows you to reduce risk if you want to. So other considerations on the whole reward versus risk type of a scenario. How large is the zigzag? Depending on how long that A wave ran, how many points it ran, then that gives you the potential price movement in the B wave correction and then the subsequent price movement in the C wave extension. So it can vary in the amount of price movements. And if it's a smaller move, a lot of people really into these lower dollar stocks these days. If it's a smaller price movement, then maybe when you look at it, and again, I'm going to be looking at options, and you do your options analysis, what's the extrinsic value, time decay, et cetera, all those things that we're looking at. Does that make sense from a risk to reward standpoint as far as moving in and entering? So that's something that you could look at. Risk is more obvious because you know exactly where the pivot point is. And then what I like to do from the options side of things, just a quick note, I don't have time to get into all of this, but I like to buy out of the money. If it's just a straight call or put trade, I like to buy out of the money options with the delta around the 25 to 30. The delta curve is a lazy S. It's not a 45-degree angle. It's not linear from lower left to upper right. It's a 45-degree angle. At the money options are right smack in the middle of the curve. The average trader, when they move into the world of trading options, if they have a $100 stock, they just automatically gravitate to, oh, I'm an options trader now. I'm going to go buy a call option, and they go right to that 100 strike call. And it's right in the middle of the curve. And if you go up The acceleration of delta is gamma, and you can move up and have some acceleration. But if you're wrong and you move down, you're moving down at the exact same speed. So the speed in which you would be making money is the same speed as you would be losing money. But if you come down further in the curve and go a little further out of the money and hit where that lazy part of the S then starts to go vertically up, now all of a sudden you've changed that. You have the greatest acceleration of delta through gamma, which means that your position would make money as fast as mathematically possible. Again, if you're right on direction, I'm not saying it guarantees you're going to make money. I'm saying the option will make money as fast as mathematically possible based on the delta gamma relationship. But then if you're wrong, you're down at the bottom of the S and the delta moves against you slower. So in essence, you have greater acceleration when you're in a profit zone, when you're right on the direction. And if you're wrong, you lose money slower. So just something to look at in your own trading. If you're haven't been a big fan of out of the money options, I know a lot of people think they move slower. It's actually the exact opposite of the case. And then people try to get away from extrinsic value by going in the money. And to me, that's going the wrong way. You're looking for that high delta, but now you're way at the top of the curve. And if you're wrong on direction on those, it's like falling off a cliff down the delta curve. So that doesn't work out so well. So when's your exact entry? On confirmation. So we have the qualification, then we have the confirmation day. We look at those confirming signals and the definition here. Here's an exact example of what we'd be looking at. So there's a zigzag that's been identified. As you can see, that one came right down to the 61.8% B level. We're watching the price go up. Now we've hit that 90% level. So now we're qualified. And then we have the confirmation day, and that's when you get in and look to wait for it to move to the next target. So getting out, always a rule to get out is if you're happy with the profit, you can get out. There's never a problem with that. You don't even have to wait for a fib level to get hit. A target price, if you have a position that's moving your way and you're happy with the profit, I've always said never second guess yourself. If you're like, all right, I'm good with this gain, I don't need any more out of this position, take the profit, be happy. And if it continues higher, don't go back and second guess yourself by saying, gosh, I wish that I would have stayed a bit longer because if I had stayed longer, I could have made more. And you'll drive yourself nuts. You'll eat yourself up from a psychological standpoint. If you were happy with the profit when you exited, be happy with it. Move on to the next one. And similarly, if you hit the fail zone and it doesn't work, you don't boo-hoo, don't get upset. Everybody's wrong on trades. We all have winners and losers. And if it doesn't work, just forget about it, follow your system, move on to the next one. And that's how you'll have the best success. Now, if you want to get a copy of this software, as I mentioned to you before, all you have to do is go to hub.com. It's all browser-based. There's nothing to download onto your computer. It's a great Elliott Wave piece of software. You can do all the things that I've shown you. The AI signals are not there yet, but they are coming, and they're coming in the not too distant future. I'm using them now. I've been beta testing them since basically September of 23. That was when the activity that I showed you on the chart occurred, and they're going to be available for everyone here probably by the time we get to the end of third quarter. So it gives you time to play around with the software and get used to it. But all the Elliott Wave stuff that I've shown you, that's all there. Everything's there. Any technical indicator you can think of is there. So it's free. As I said, it's browser-based. Take a look at it. Go play with it. Utilize it. You can use your own trading system if you're not an Elliott Wave fan. If I haven't dazzled you in trading a zigzag within a wave 3, you can still utilize that for any other kind of technical trading system as well. So I thought I would just show you a real quick picture of what it looks like. So here is the current S&P. This is what the software looks like. You can see how it labels the patterns. It gives you a wave 5 target area. And so there you can see there was a zigzag within the wave 5 there. They're everywhere when you start looking for them. It's one of those things, I kind of view it as like one of those pictures that used to go into like a Spencer's Gifts or something, and they had a poster and it looks like a whole bunch of kaleidoscope, graphics and things just messing with your mind. But then when you stared at it long enough, all of a sudden you would see a different image. If you're familiar with those type of pictures, that's the way I feel like these zigzags look. Most people look at charts, they see upward and movement and downward movements as the market moves in impulses and corrections, but all of a sudden you will start to identify zigzags in there, and then you can just use your fib tools to measure what's the retracement, where's the extension, etc. And then over here, when this is available, here's an idea of what happens with the AI scores. Now you can see this one isn't one that we would use because the score is only 16%, but once those signals are available, you're going to have those as well. Once again, they're not there now, they're on mine, but you will be seeing them in the not too distant future. So you'll have time to play around with the software, learn it, get used to it, get ready for it, and then when that comes out, you'll be all ready to go. So just wanted to give you a quick look at it so you had an idea. It's like anything else, there's a little bit of figuring out where everything is, but then once you start to become comfortable with it, and there's a lot of support, support at hub.com can help you if you have issues. There's training videos to learn how to use it, etc. I think you'll find that it's a pretty amazing piece of software when you get used to it. Okay, so with that, I am finished. And if there's a couple questions, maybe I have a couple minutes, or if I've used my time, I apologize for not leaving time for questions, but I'll take a look and see if there's any questions that perhaps it can answer real quick. Thanks, David, for putting the link in the chat box. Appreciate that. Let's see. Lightning round, you download that. Already loving the presentation. Thank you very much. Should always be a disaster stop in the market. Internet goes down, fear locks up, etc. Can be way away from the market, but you don't have to sell your home to make a margin call. So I agree. You always want to have ideas of when to exit any position, and AI signals give you that question. How long will this be free? Well, there will be a fee once the AI signals come out. And the reason for that is, and people ask, well, who is, how does this hub organization have these data scientists locked up? Who's to say they couldn't go to the highest bidder, showing that they have a proven product, they go somewhere else? Well, the hub organization has them locked up contract-wise. They can't go anywhere else. So the data scientists are for them. And of course, we don't want everybody on the planet using these same AI signals. It's the way everything works. If it gets too spread out, then perhaps the signals won't work as well. So there will be a fee when the AI signals come out, but it's going to be free until then. And then you'll have your choice. I mean, you don't have to take the AI signals if you don't want to. So, but I think the proof is in the pudding. I've shown you the results. It's pretty amazing, and being out in front of it. But for now, it's free. So take a look at it. Thank you so much for your time. I really appreciate it. Time's the most valuable asset we all have. I very much appreciate you taking some of your valuable time to watch this. I hope maybe I showed you something that you hadn't heard before, and have a great rest of your day. Look forward to talking again soon.